How can these limitations be mitigated? Could possibly through collaboration in any way like that?
So insurance has its limits and it's important to be clear about them.
My name is Charles Osborne, Director here at Trade Finance Global.
My name is Alexander Klepp and I lead the single risk underwriting department at Credendo Guarantees and Specialty Risks.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global.
Hello and welcome to the next instalment of TFG's Trade Finance Talks. My name is Charles Osborne, Director here at Trade Finance Global. As always, we're joined by the best experts in trade finance, and I'm very pleased to be joined by Alexander Klepp, Underwriting Manager, Single Risk at Credendo Guarantees and Specialty Risks. Welcome, Alex.
Thanks so much for the invitation. Great to be here today. Maybe I'll kick off with a bit of a headline. Deals don't fail for lack of opportunity, they fail for lack of certainty. My name is Alexander Klepp and I lead the single risk underwriting department at Credendo Guarantees and Specialty Risks here in Vienna. I've spent close to 2 decades in trade credit and political risk insurance across developed and emerging markets, underwriting everything from classic trade flows to complex bank-driven structured transactions. At Credendo GSR, my role is quite straightforward in theory, but demanding in practice. Turn uncertainty into something financeable. That means structuring non-cancelable credit and political risk insurance that allows banks, traders, and corporates to keep doing business, even when geopolitics, regulation, and volatility are working against them.
Thank you very much, Alex, for that very comprehensive overview. So you mentioned, obviously, I'm going to straight away leap upon that you mentioned geopolitics, naturally with what's been happening this year. And I think the beginning of this year has been even more chaotic than the beginning of 2025. I don't think we all thought that was going to be possible, but here we are. So if we look over the past few years, and particularly the last few months, as I mentioned, political volatility has become second nature to the international system. Consequently, the demand for credit and political risk insurance has grown. So Alex, how is CPRI adapting to rising demand and increased complexity?
Thank you for the question. So what we are seeing today is not just higher demand, it's better informed demand. The CPRI market has matured significantly. Capacity has expanded, new insurers and MGAs have entered, and transaction sizes have reached levels that would have been unthinkable a decade ago. But this is not just easy capacity. Underwriting has become far more selective, technical, and transaction-driven. Clients now expect insurance to work seamlessly with capital relief, sanctions compliance, structured trade finance, and long tenors. In response, CPRI has evolved from a defensive product into a structuring tool. The focus is no longer only on what can go wrong, but on how a transaction can remain resilient for 5 or 10 years. In short, insurance is no longer just protection, it's infrastructure for global trade.
I think that's a great way of putting it. And I think you mentioned obviously underwriting becoming more selective. I think that's very interesting. We've certainly seen that over the last few years. And of course, ESG has come into quite a bit as well. And I think that has a major impact. Going back to the geopolitical side, how are country-specific political risk assessments shifting as geopolitical volatility and violence become the norm? Because obviously we saw tariffs seem to be changing every week, every month almost. So this must be quite chaotic for the insurance side. How have you kind of seen these shifts yourself?
The biggest shift is this. Volatility is no longer the exception, it's actually the baseline. Country risk today is less about forecasting a single election or crisis and more about understanding institutional strengths, policy credibility, and reaction under stress. Violence, sanctions, capital controls, and regulatory intervention are nowadays baked into our assumptions much earlier than before. That means underwriters rely less on headline indicators and much more on transaction architecture, where cash flows move, how contracts are enforced, and whether political risk is isolated or contagious across the structure are important topics in our risk assessments. Good underwriting today asks one simple question. Will this transaction still hold when the environment deteriorates?
Yeah, absolutely. I quite like that there. Volatility is now the rule, not the exception. I think that's quite a very good way of putting it. And certainly we've seen that over the last few months as well. I've been speaking to a lot of people personally about supply chain disruption, which we'll get onto a little bit. I've been speaking to brokers about things like trade disruption insurance, things that I didn't know too much about until the last sort of couple of years with the volatility. So I think that's particularly interesting. And just moving on to sort of supply chains, is obviously that's really hit the headlines with the Strait of Hormuz and kind of what's going on over there. How can CPRI assist countries in diversifying their supply chains as traditional supply chain routes become obsolete, or in the case of the Strait, perhaps become too dangerous?
This is exactly where CPRI quietly becomes a strategic enabler. As supply chains reroute away from established corridors, whether for geopolitical security reasons or sustainability reasons, financiers are forced into new jurisdictions, new counterparties, and consequently new risks. Often the economics work, but the confidence doesn't work. Insurance bridges that gap. By covering non-payment, transfer risk, or political interference, CPRI makes it possible to finance the unfamiliar. It allows banks and traders to support diversification without having to fully internalize sovereign or political risk. Without insurance, however, supply chain diversification stays only theoretical. With it, it becomes executable.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
Absolutely. And I think it's interesting if we look at the trading houses and the trading entities, it's quite interesting. We've certainly seen over the last few months, the larger trading houses have added liquidity buffers and things like that. They've added more capital. I'm always quite interested to see how mid-cap and SME traders, they perhaps don't have that luxury. So it's going to be very interesting to see how that might happen. Alex, in your experience, has the risk appetite changed for trading entities as a whole?
No, actually, risk appetite hasn't disappeared. It has become much more selective. Traders are still operating in high-risk environments, but they are far more disciplined about which risks they retain and which they transfer. Balance sheet volatility, liquidity shocks, and prolonged disruption are far less acceptable than before. Trade credit insurance and structured trade credit solutions can absolutely play a role here, but only when they are embedded early. Insurance works best when it supports logistics, planning, contract design, and financing strategy, not when it's added as an emergency fix. Just to be clear here, trade credit insurance doesn't insure disruption. It only insures the moment disruption turns into a non-payment event. So the smartest traders use insurance not to chase risk, but to stay operational when others can't.
What are the limits of insurance for traders navigating volatility?
As you already mentioned, the big traders have added huge facilities into the market. Some of those were actually done simultaneously at the same time, like all of the refinancing. This is public information in the end. The big traders like Trafi, Vitol, Mercuria, or even Gunvor, they have signed huge facilities recently. We talk about billions, just to be prepared, for the high volatility and price shocks, and also the margin calls, because they need this liquidity. And this is on top of the existing, normal RCFs that they have already in the market. Unsurprisingly, the banks were prepared to do this, and not even, a small panel of banks, but huge amounts. So the core banks were prepared to provide millions of additional financings within a week or two. This shows, how flexible actually, first of all, the banking market can react. And in the back, of course, also the CPRI market, which probably, I don't know a figure as such, but I would not be surprised if we cover more than 50% of this exposure. And there we talk about billions in the end. So in my opinion, for the right risk and clients, there will always be capacity. And that's exactly the point here. If you start actually to embed and introduce insurance into your risk management at a very early stage, and you support the clients during good and bad times, we will be there, especially when things get tricky, okay? And when you need the support to make business. This is, of course, different, if a situation gets like, the fire is already burning and then you start to seek insurance. Then it will be a little bit more difficult, to obtain cover. That's the point. To spring in CPRI early in your risk mitigation process so that you have it when things get really difficult. So I would recommend, every company actually to make use of trade credit insurance to protect themselves against protected defaults, payment defaults, or even just political interference, and not only for the bigger transactions.
Thank you very much for that, Alex. And how can these limitations be mitigated? Could possibly through collaboration in any way like that?
So insurance has its limits, and it's important to clear about them. It cannot fix weak fundamentals, poor counterparties, or transactions that are structurally fragile. It doesn't replace commercial discipline, it actually rewards it. Where transparency, alignment of interests, and robust contracts are missing, insurance will eventually step back. The strongest deals today are built through collaboration. Traders, banks, insurers, ECAs, and as well multilaterals are all playing their role. When risk is shared sensibly and structured properly, insurance becomes a stabilizer, not a last resort. Or to put it very simply, insurance doesn't make bad deals good, but it makes good deals possible.
Right. And there you have it. So the answer is bring in CPRI very early into any of these transactions. You'll be a lot better off. Thank you very much for that, Alex. I think there's some very interesting points around trading, risk appetite for insurance, how CPRI insurance can be used properly and engaged throughout the supply chain, which I think is very interesting. And particularly when it's used correctly, geopolitical volatility, trade wars, tariffs, all of these things can be effectively mitigated if this is brought in early enough. Is there anything perhaps we can end this podcast? Any last words perhaps on the current market and what the future may hold?
First of all, I would like to say thank you for having me on the podcast today. And if I had to leave your audience with one takeaway, it would be this. The future of trade finance isn't about avoiding risk. It's about building transactions that can survive uncertainty. And that's where CPRI continues to play a critical role. Thank you.
Thank you. And thank you very much to the audience as well for listening. We've been very happy to have Alex from Credendo with us today. Credendo, of course, were the founding partner of inaugural TFG Geneva event. We were very proud to partner with them, and we look forward to working together on more podcasts in the future. Thanks, everyone.